Hey everyone, welcome back to Corporate Decoder. Ever feel like companies are speaking a different language? Well, today we are going to translate Energy Vault Holdings' latest report and see if their plans to generate cash are truly set in stone or just castles in the sky. In short, Energy Vault told investors that a few project financings and tax credits should bring in a good chunk of change, between $70 and $80 million within the next few quarters. They also said they aren't planning to use their ATM facility, which is basically like a company credit card, and that they are aiming for a positive adjusted EBITDA, a measure of profit, by the end of 2025. Let's break it down. First, let's dive into what Energy Vault's management shared during investor calls. They were answering questions about their earnings call from March 18, 2025. It seems investors were digging for specifics, and the company provided some interesting details. The big news is about project financing and investment tax credits, or ITCs. Think of these ITCs like government incentives to encourage investments, in this case, likely renewable energy projects. Two projects, one in California called Calistoga Resiliency Center and another in Texas called Cross Trails, are expected to bring in around $60–65 million. That money is coming from the project financing itself and from cashing in those investment tax credits. Adding to that, there's another ITC related to a microgrid project in Snyder, Texas. This one is projected to generate about $10–15 million. So if you add it all up, the company is expecting a total cash injection of $70 to $80 million from these deals. When will they get this money? Management said they expect these deals to close and the cash to become available within the next 2 quarters, meaning Q2 and Q3 of 2025. The first one to close is expected to be the Calistoga project in April of 2025. Getting the timing right on these things is crucial because it impacts their ability to fund operations and future projects. Now, let's talk about that ATM facility. Investors were clearly wondering if the company planned to tap into this line of credit. Management clarified that there have been no authorizations from the board or a pricing committee to use it, so for now they are not planning to draw on that credit line. Here's the part everyone is interested in: profitability. Management said they are aiming to reach a positive adjusted EBITDA in the fourth quarter of 2025. Adjusted EBITDA is a measure of a company's profit before some items are taken out, like interest, taxes, depreciation, and amortization. Hitting this target would be a big step for Energy Vault, signaling that they are on the path to becoming consistently profitable. Now there's a small catch. The company said they can't provide a detailed breakdown or reconciliation of how they will achieve this positive EBITDA. It's because predicting those numbers depends on future events that are hard to control. This means that while they are aiming for this goal, there's no guarantee they will hit it. This brings us to the cautionary note about forward-looking statements. Basically, the company is saying, hey, we're making predictions about the future, but things could change. They're reminding everyone that their expectations are based on current information, and there are risks and uncertainties that could cause actual results to be different. These risks include things like failing to close those project financings and tax credit sales, changes in their business strategy, problems with their products, and the ability of their suppliers to deliver materials on time. It also includes things like war or other hostilities. They point out that you can find a more detailed discussion of these risks in their annual report. Basically, they are covering themselves legally and reminding everyone that the future is uncertain. Now let's step back and look at the big picture. Energy Vault is betting big on these project financings and tax credit sales to boost their cash flow. If they can close these deals as planned, it would give them a significant financial cushion to fund their operations and pursue new projects. Not using the ATM facility is also a good sign, suggesting they are confident in their ability to manage their finances without relying on credit. However, there are definitely risks to watch out for. The biggest is the uncertainty around those project financings and tax credit sales. If those deals fall through or get delayed, it could put a strain on their finances. Also, their ability to reach positive adjusted EBITDA by the end of 2025 is still just a goal, and there's no guarantee they will achieve it. Overall, Energy Vault seems to be making progress in its efforts to commercialize its energy storage technology. The expected cash inflows from project financings and tax credits are encouraging, and their focus on profitability is a positive sign. However, investors should be aware of the risks and uncertainties that remain. The energy sector is volatile, and external events can always impact Energy Vault. Thanks for watching. If you found this decoder helpful, please like, subscribe, and let us know what other companies you'd like us to decode in the comments below.